Hey guys, it's Walter here, and I have a video, and I want to talk about something that it kind of complements price action trading actually, and it's called pivots. Some of you are probably familiar with pivots. I'll just give you a quick refresher if you've heard of them and you don't remember them. Pivots are based on the previous day's range. So you're looking at the 1 hour chart here. I probably should draw some lines in here for the days so we know when a new day starts. But basically, you can see here what it's a very simple formula, and they used to use them in the pits. A lot of markets don't have pits anymore. They're all there's a computerized market that matches up orders, but there used to be guys in pits, and they would keep track of basically how far the market had gone relative to yesterday. So these pivots here are drawn based on yesterday's price range from here to here. All right, so let me show you. The blue line in the middle here is just called the daily pivot. And these are obviously daily pivots that I'm looking at right now. But you can also do this for weekly, monthly, or I suppose yearly pivots if you want as well. But basically the idea is this is the middle. This is where the market tends to hover around, which is the daily pivot. Now, we've talked about other systems using the pivot, the daily pivot, but I haven't talked about general big picture stuff in terms of pivots and how you can use them in your trading. And this is how you can do it. If you know where the daily pivot is, which is right here, then you'll know that there's going to be 3 lines above it and 3 lines below it. The 3 lines below it are S1, S2, and S3. That just stands for support. So it's not necessarily lined up with support and resistance zones that I use to trade, but they're just considered potential support areas if the market does get that far. You can see on this day it didn't go that far. It actually hovered right around the pivot. Now the ones above are R1, R2, and R3. And these, of course, are areas of potential resistance if the market does get up that high. Now let me show you how I use them. And they're really useful, I believe, not necessarily to use as support and resistance areas, although they can be if they coincide with an area of standard support and resistance, like this one right here. You can see this area right here, around 88.91. This is the Aussie dollar I'm looking at. That actually coincides quite well with this zone down here. So in that case, I'd say, yeah, that's pretty good. But normally, they don't necessarily line up with those levels in my estimation. If I see a day where the market has hovered between R1 and R2 and really hasn't gone beyond that, I would basically call that a small range day. A day that's not likely that didn't really go anywhere. And if you look at the Aussie dollar on this day, you can see that it went all up from peak to trough. It only went about 63 pips. Now that can be, there's a couple of reasons why that might happen. First of all, the day before might have been such a wild day with such a great wild range that the pivots are spread out. So that's one reason why that might happen. But you can see here on this day, it didn't necessarily mean that the market went 92 pips, which, you know, that's totally doable on the Aussie dollar. Now, if it had gone 192 pips, I would say, okay, yeah, then these pivots are going to be spread out the next day, because again, remember, they're dependent on the previous day's range. That's how they're calculated. So let's just keep going here, and what I want to do is show you that when you have a day like this, where the market's really tight and hasn't really gone beyond R1 or S1 and kind of stuck in there, that means get ready, because you might see a day where the market breaks out and really takes a rapid run. It's kind of like this idea of having an inside day, or a day where the market didn't really go anywhere relative to the previous day. If that's the case, get ready, the market's gearing up to go. Now you can see the next day here, although we hovered around the pivot during the Asian session, we finally fell down to R1 here, and then the market gapped up with a new week here, and it went right, I mean the gap went right through from the pivot to R1 up here. So whereas on this day we had a really tight range, because this day right here had such a tight range, only 66 pips, that means that we're going to have really close pivots here, right? Because it's, remember, these pivots here are calculated on the previous day, which was so tight and didn't go anywhere that it was obvious that it's likely that the market is going to go to R1, R2, or possibly even R3, or S1, S2, or possibly even S3. And that's exactly what happened. It gapped right up to R1, and now we're all the way up at R2, and then bam, we hit R3. Now it's actually quite rare for the market to hit R3. So this brings up the second principle. Principle number one, of course, as I first mentioned here, is that when the market stays between R1 and S1, get ready for a breakout. That's what BO means, breakout. So when the market stays between R1 and S1 all day long, get ready for a breakout. So it stayed between R1 and S1. Stay between R1 and S1. Finally, the third day, bam, there's your breakout. And again, there's two things working here. One, the market's been coiled up for a while. And two, because the market's been coiled up for a while, those pivots are going to start to contract. And you can see that's exactly what's happening here. These pivots are starting to get closer and closer together. And why? Because the market has really sort of calmed down, and so those calculations are getting tighter and tighter for the pivots. Okay, so let's keep going here. We've hit R3. Now, the second principle is when the market hits R3 or S3, get ready for a retracement. Right? It makes sense because, again, the opposite thing is happening here. When the market hits R3 or S3, get ready for a retracement. So it's sort of the opposite rule of the first one. The first one is get ready for the market to really go when it coils up. That makes sense. And pivots just sort of show you visually that the market is coiled up. And the second thing is when the market really breaks out, get ready for it to come back down and calm back down and come back down to possibly R1 or even the pivot. So let's see what happens next. Now, it will sometimes market just keep going and keep going and going and going because it's in a wild trend, and that's going to happen. But overall, normally when it gets to the edges here, it'll come back. And look, that's exactly what happened here. The market went up to R3, and guess what? It came back 40 pips, right? It went up and then came back 40 pips. It looks like that was during the New York session that it came back. Yeah. Okay, so now the next day we hit R1. Come back to the pivot. We're almost to R2. Ah, hits R2. And then that's it. Next day hits R1, R2, and almost R3. So the point is here, and remember these pivots are spread out because the previous day had a nice long range. There was actually, it went pretty far between the low of the day and the high. You know, 102 pips, that's nothing to sniff at. So the next day that it went this far tells me it's probably going to retrace at this stage. And look, it comes back to the daily pivot. After it did that wild run up to R3, it comes right back to the daily pivot. It's very common for it to do that. In fact, it even went lower. Now, it didn't really go much beyond the daily pivot. So again, what are we waiting for? Because it was between R1 and S1. Now again, R1 and S1 here have a huge range because 150 pips between R1 and S1. And the reason why, of course, is because the previous day it really went and took off. So now we would expect it to probably get ready to go beyond R1 or beyond S1 and hit R2 or S2. And it does. Here it hits R2. Is it going to hit 3? No. So there you go. So that's basically it, guys. I hope this makes sense. The pivots are really good. I like to use them with price action. So if I see that we've gone to R3, I want to see a retracement, but I really don't want to just get in just because it hit R3. To me, that's crazy. I want to see price action. I'd love to see a support and resistance zone line up, those sorts of things. So here's the two principles with pivots. When the market stays between R1 and S1 all day long, get ready for a breakout. And when the market hits R3 or S3, get ready for the market to retrace, possibly all the way back to your daily pivot, which of course on these charts is that blue line here like that. I hope this helps. I wish you happy trading, and we'll see you in the next video for the Daily Trader. Take care. Bye.